In this presentation, we will review the reports, the financial statements, the balance sheet, and income statement or profit and loss after entering the data from the second bank statement that we are working on into QuickBooks. For more accounting information and accounting courses, visit our website at accountinginstruction.info. Here we are in the home page. We currently have the open windows open. We can open the open windows by going to the view drop-down and selecting the open windows list. We've entered data from the second bank statement into the system. Now we're going to take a look at the major reports, those being the balance sheet and the income statement. To do that, we're going to go to the reports drop-down up top. We're going to go down to company and financial and first start off with the balance sheet. So we have the balance sheet. We're going to customize the date so that we can have a date range that we'll be working on. So when we drill down on the data, we'll see the date range or zoom in on it. And so we'll go for the full time period now, 01/01/19 to 02/28/19. We've entered 2 months worth of data. We started at January, went through February 28th. We're going to say OK. This is what we have so far for the 2 months of information. It's still pretty straightforward for the balance sheet. All we've got are the cash information and then the equity, because all the information that we've been putting into place has been related to the cash account, and the other side has been related to the income statement in some way. And that's because we're on a cash basis. We didn't enter any beginning balances, and we're trying to not have the accrual type balances in place. However, once we do some adjustments, once we look at some of our open items, even on a cash basis, we will have to deviate from that to some degree. We'll have to enter some information up here, such as large purchases of equipment or large investments. If we happen to have investments, we'll have to put up here in terms of assets. We can't just expense them at the point in time that we pay for them. And so even on a cash basis, we'll end up doing that. So we'll see it'll get a little bit more complicated. But from this point, we see that we just have the cash here. If we double click on the cash, we can see all of our transactions that we have done so far, both in January and in February. We can see that QuickBooks will populate that information, give us a transaction detail list here. Transaction by account, they'll call it. Now, notice over here as we go through these, what QuickBooks makes when we enter this data. We've entered this entire thing just with the register. And note what it creates over here is an account type. And these are the forms that QuickBooks thinks of, even though we entered the data into a register. It's either going to be a check most of the time or a deposit, because that's all we're entering into the register. In other words, when we go into QuickBooks, any of these, if I double click on these, double click and zoom in, it doesn't take us to the register, it takes us to this form that QuickBooks sees. So just be aware of that. This form correlates, if we go to the home page, to this deposit form. So anytime you have a deposit form, it's just like this form here. So I'm going to close that out. We're going to go back to the transaction detail. And the checks, of course, are all going to be checks. So if I double click on a check, it looks like a check form. So even though we entered it directly into the register, this is what the actual check looks like. It's a checking account up here, meaning it's going to decrease cash. Here's the other side of the transaction. So we can see those two sides, same information in here. It just gives it a little bit different look and feel as opposed to entering it directly into the register. But it's the same thing because this was generated from us entering directly into the register. So we're going to close this back out, and that'll be our data. We're going to close this back out and go back to the balance sheet. So that's going to be the essence of the balance sheet. Remember that on the equity side of things, we have two accounts here. Really, it's only a sole proprietor. So all equity really represents who the money is owed to. So this is what we have in the company, just representing cash, because we're not representing anything other than cash in terms of assets so far. We will do so. Equipment, investments, we'll have to break those things out. But this is what we have at this point. Note that if there were other things in the financial statements prior to this, such as equipment and investments prior to this, we could make the decisions to put that into the system, or we could say that, hey, we're just going to basically go from this point forward. Any prior data is the prior data, and we can work with an accountant to take that data and tie it out to the prior data. In other words, the main thing that needs to tie out to prior data is usually going to be the equity here. And so other than that, if it was just an income statement that we need basically to create taxes and to track the data from this point forward, track performance, in other words, then what we're really looking for is the profit and loss. And so just keep that in mind as we're continuing the books. Entering the beginning balances might be something that we can think about putting in there, but if our goal is to tie out equity, which may be, if we're at a larger company, we'll need to tie out equity, we probably want to do that with an accountant, a CPA firm. So our goal then, as the bookkeeper, enter current data for the current time period, get the profit and loss correct, and then if we need to tie that in to the prior retained earnings, to the prior equity accounts, in this case owner's equity, then we'll work with a CPA firm to do that. If not, if we only need an income statement, then we'll have the performance documentation with this type of data entry, and we can use the income statement or profit and loss for the creation of the taxes. But note what equity is here. We're going to have, this is who has claim to the money. We have no liabilities in place right now, and we may, depending on how we want to deal with credit cards, look at that, but we're not dealing with accounts payable or anything like that. If we have a loan, we may have to deal with that, and we'll discuss those things. So the equity has who has claim to it. So right now, we're saying that this has been earned, either input by the owner or earned by the owner through net income, and it's all allocated to the owner at this point. So this is what the company has. This is who has claim to it, the owner. No liabilities at this point. This side down here is broken out between these two elements. This side is owner's equity. That's what we actually put in, the owner's original investment, the beginning balance in the cash flow statement. And this is net income, which the QuickBooks system puts into the balance sheet. So it's just going to kind of put that there. It's net income for the year, which will eventually roll into equity. Let's take a look at net income on the profit and loss now. We'll go to the reports drop down. We're going to go to company and financial. We're going to go to reports, profit and loss standard. Date range, we'll do the whole range again, 01/01/19 to 02/28/19. This is what we have so far. So January through February, we've got this much in sales, and a lot of it is uncategorized. If we double click on the sales, we'll see the same kind of transaction detailed report, and we'll see it's all basically the type of a deposit. These are all deposits because that's where we got all this information. All deposits that we enter, sales will be made of all deposits. Almost all deposits will be sales unless we determine otherwise. And it's a deposit is the number, memo, all deposit. The other side's going to the checking account, as is indicated by the split, because we entered them all in from the checking account, from the check register, and the amount. So if we double click on any of these, it will of course then be, once again, the deposit screen. The deposits that we make then, everything we do, having two sides to it. In this case, increasing the checking account and increasing the sales. So closing this back out, the uncategorized income also deposits, but those were those weird ones we didn't know what to do with. We're still going to have to go in here and figure these out. We're going to have to go in here, double clicking on them, double click on these items, change the undeposited fund or undeposited income or uncategorized income, let's call it, to the proper location is what we're going to have to do with the uncategorized income. By the way, the reason I have undeposited in my head is because if we went through the standard process, and you may see this in your bookkeeping if you're doing bookkeeping with other industries, is if you go to the home tab and you were to go through the receivables and then make the deposit, it would go in and out of an account called undeposited funds. We're not going to be dealing with undeposited funds here because we're entering the transactions directly into the checking account or skipping this full process, going right to the deposit, right to the in process, and going right to the register in order to enter that in process. Let's go back to the transaction detail, and I'm going to close this back out. I'm going to go to this make deposits to close that out. I'm going to close that out. Let's go back to our profit and loss. The expense side, notice we have a nice grouping of expenses now, so you can imagine if we're making the tax return or if our tax preparer needs the information, we're going to say, yeah, we took all these transactions and we sorted them in this nice little grouping. All you got to do is enter this into the system now for a tax return, basically, in terms of the business format of the tax return. So that's what we have there. And note that we still have this uncategorized expense, however, We put it there on purpose. We're going to have to get rid of those. The way we'll do that, same thing, we'll double click on it. We will double click on any of these items and then allocate it. Notice it's a check now. We're going to allocate it down here to a different account, whatever account is applicable. Closing this back out, closing this back out. Now note we've done 2 months. If we want a side-by-side comparison, we could do that a couple different ways. One, we can go to the totals and go to sort by month or show columns by month. Here's January versus February. So that's one way we can see this kind of comparison, which is nice, and we see the total. This is also a way that we could see more than 2 months. We could see the entire year in this way, and we could do some quick analysis and say, okay, yeah, that looks kind of reasonable. If we do this another way, we can go to customize reports, and we could say just the month of February, the current month, 02/01/19 to 02/28, just the month of February. Then choose the prior period, choose the change in amount and change in percent, and that's going to take the current period, February, and then show the prior period to it, January, and the difference. And again, this is going to be useful for us to say, okay, did we do things properly? You could say, okay, sales looks kind of proper. It looks higher in February. Maybe that would be normal. And then we've got this uncategorized funds in February, uncategorized income. So that's obviously something we have to do something with. And then, so none of it was in February. It was in January, because that's what this difference is. It's February minus January. It's negative. And then we've got these differences down here, and we could say, okay, bank service charge the same. That seems reasonable. Supplies, difference by 120. That's fine. Rents the same. That's what we would expect. We've got repairs and maintenance. Okay, that's going to happen when it happens, suppose. And then telephone expense. And we could see these differences. And we can look for big changes, of course. And if we see big changes, like repairs and maintenance, if we saw some huge amount in there, we'd say, hey, maybe that's not a repair. Maybe that's a improvement. Maybe we need to capitalize that or something like that. So these are 2 ways we can see this report that's really useful. Next thing we want to look at, just the data that we have been entering has been put in. If we go to the vendors dropdown and the vendor center, we see that our vendors are being generated as we go. So if we ever go in and we misspell the vendor or something like that, which I do every once in a while, you could go back in here and then change the vendor. So we can right click on these, we can edit the vendor, and we can change the data. Now, of course, there's a lot of information in here we could track by vendor, but we're not really in the job of doing that in this little kind of quick bookkeeping thing. We're just trying to enter the vendor, get the data in there for the financial statements. So really, all we have is the name. We don't have any balances. We're not tracking accounts payable. All we're doing is entering the vendors as we pay them. But as we do that, we do get a list of vendors. If I close this back out, and if we have a question about something, a question about prior transactions, say we're trying to see what we paid to the IRS, we can go to this vendor center and run a report based on this information, and that could be useful. That could be something our client would need. They might need, hey, how much did we pay to the IRS? Blah blah. We could check the account and see where did we put it in the account, or if we're not sure, if we think, maybe we put that in a couple of random places, maybe we messed up or something, or we didn't know where it should go. Then we can go to the vendor and we can say, where did we put it by vendor? And we could line up and make sure that we all put all the information to one account. So this is going to be the type of information we need to do if there's any kind of issues, any kind of problems. What do we do first? Probably go to the reports, profit and loss, and then drill down on the reports and say, what makes up this account? If there's any questions about it, we could say, what makes up this account? And then if we can't find it by that, we're probably going to go to the vendors. If there's a question about something like taxes, or where did we categorize this payment, or did we pay these people, then we go to the vendor center. We can find the vendor that we had. We can run the report. We could change the dates to the current time period we're on, 01/01/19 to 02/28/19, and we could find this information. And notice in this system, we don't have to ask the question, did it clear or not so much, because we're going to reconcile the bank account, but all this information came directly from the bank account. So all this stuff is stuff that cleared the bank. So in other words, if we were entering this stuff into the system, and then the bank was double checking it. Like if we wrote a check to the IRS, the question then is, did it clear the bank? Did the IRS actually cash the check? In our case, there is no question about that because we got the check from the bank statement. So it must have been cleared. So anything that's in our system is something that has basically cleared if we're entering the system, the bookkeeping in the system in this way. So those are just a couple tools that we'll use to monitor the data, to make the reports, to answer some kind of questions that could be happen as we start entering this data as time passes. For more accounting information and accounting courses, visit our website at accountinginstruction.info.